Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers as we go over the fact that mortgage rates are collapsing and a September rate cut is all but guaranteed. Now, today's discussion is going to include what happens after mortgage rates are lowered, or rather the federal funds rate is lowered. What happens during that campaign? Now, the second thing we're going to go over is why the Federal Reserve would start a rate cut campaign to begin with. And the most important thing is what we can expect as consumers, especially considering during the last rate cut campaign, it lasted 5 years and 10 months from start to finish. Now, as it stands right now, when we take a look at just the 10-year Treasury over 3 months, we peaked May 21st of 2025 at 4.605%. It has gone down to, as you guys can see here, at least as the recording of this video, to 4.249%. That's about 35 basis points over the 3-month period of time. When we look at conventional 30-year fixed interest rates, we peaked around the same time, May 21st, as you guys can see here, at 7.08%. Fast forward to today, they're at about 6.55%, which means in about 3 months, residential mortgage rates have also gone down 53 basis points. Further on in this video, I'm going to show you guys how much of a difference that makes to your actual mortgage payments. But first, Mitch Vexler, happy Thursday. How are you today?
It's been a very long morning. It literally has been nonstop since 2:30 this morning. So late last night, we were speaking to somebody who's representing another person that's running for governor, and that started spinning a whole bunch of required data from us to them. And then also last night, I get a phone call from an attorney who's in the process on Friday morning of having his house foreclosed upon with no notice and no opportunity to cure. So that's an interesting situation. And so far this morning, 3 people, which is good, reached out, and they're doing the research now. People are beginning to get this. It's the outstanding fraudulent school district bond debt divided by the amount of houses in their district. 3 independent people, 1 in Texas, 1 in Missouri, and the other actually in Texas as well, a place called Spring Branch. So people are beginning to wake up and get what we're saying, and it's all good.
Right. And a special shout out, I don't want to throw around any names, but Doc Chambers, hit us up. We will help you get elected, especially if you go in front of a camera and say you will repeal property taxes and you explain how. We got you, buddy. Hit us up. My email is in description. Again, Doc Chambers, I'm talking to you. Hit me up. We will help you. Now, let's start by talking about what happens by looking at 3 different charts. A few things happen when the Federal Reserve starts a rate cut campaign. A few of those things would be recession begins, unemployment skyrockets, interest rates go down for several different years, asset prices also go down. I'm about to show you guys that for a few years. And what I'm also going to show you is rates and values of assets go down at the same time. But the first chart we're going to look at is the unemployment rate. When we look back at the 12 last recessions, going back to 1950, we have had 6 recessions to where unemployment was either the same or lower than what it was right now. And we've had 6 recessions where unemployment was higher. And what I'm pointing out is the unemployment rate itself does not tell us whether or not we're headed into recession. The trajectory of the unemployment rate does. And by the way, you guys, I will revise this eventually. The black arrow, as you guys can see here, represents unemployment skyrocketing during that recession. I also put what the unemployment rate was going into that recession. So the first recession, going again back to 1949, 1950, the unemployment rate started at 3.8%. Again, you guys, right now it's 4.2% prior to any more revisions. Get it? Now, the second one here in 1955, the unemployment rate was 2.6%. Obviously, you see the black arrow there as unemployment skyrockets upward. The next one here, guys, is 4.1%. You see that here. Again, unemployment skyrockets. The next one, 5.2%, so higher than what we have now. But the next one here, 1970s, the unemployment rate was 3.5%. And I also want you guys to pay attention. Under the unemployment rate, I have that red arrow right there showing you guys the gap in recessions, because all the way at the end, I'm going to show you that we are long overdue for an economic depression. It has been so long since we've had a reset. Now, the next one here is a 4.6% unemployment rate, skyrockets up into recession. Next is 6.3, next is 7.5, obviously skyrocketing through recession. Next recession in the 1990s started at a 5.2% unemployment. The dot-com bubble recession started at the same unemployment that we have right now, 4.2%. You guys can see that skyrocketing upward. Now, the GFC unemployment was 4.6%. 9.7, obviously skyrocketed up to around 10%. And also, you guys, the lockdown recession, we won't even call that a recession, but if we do, the unemployment started at 3.6%. And look at the gap right here. Look at this arrow. So the red line represents the fact that essentially, going back to the 1950s, we've never had a time where it's taken so long for us to go into recession, probably because of the overwhelming amount of inflation. But I want you guys to understand this because there's a lot of narrative saying that the labor market's strong and we're not going into recession as a result, but it is not an indicator until after we go into recession. After we go into recession, unemployment rate skyrockets, not before. As far as what happens when the Federal Reserve starts an interest rate cutting campaign, remember, first of all, that's the federal funds rate. So that's like the overnight or one-day rate. We're looking at the 30-year fixed rate residential mortgages, which closely tracks the 10-year Treasury. Nevertheless, when I look back at our last global financial crisis or our last Great Recession, you guys can see here that interest rates right before they started the campaign to decrease and cut interest rates peaked at 6.73%. That was July 19th in 2007. It took 5 years and 10 months. In other words, don't rush. This takes a long time for the pendulum to swing, almost an entire decade, 5 years for the swing to actually go to the other side. But look at this, guys. 5 years, 10 months, ending around 3.35%, May 2nd of 2013. So again, 5 years and 10 months for interest rates to go down 330 basis points, or a little over 3 full percent. So again, don't rush immediately after they start cutting interest rates. We have time, you guys. We have lots of time. I also wanted to show you guys that during recession, that asset prices also go down. That's why we've been telling you guys, maintain your purchasing power and be patient, because there's a high probability that you can find the deal of your dreams. So as you guys can see here, this is average home sales prices in the United States. Now, the first thing that I want to point out is home prices actually started going down at the same time that they started cutting interest rates. You guys see here in Q2 of 2007, that's when home prices started going down, and it took 6 years to rebounding finally in Q3 of 2013. We had a 5-year time period before essentially the housing market reset. So a lot of things happen when the Federal Reserve starts a rate cut campaign, not this like 50 basis point random rate cut to appease some people. I'm talking about an actual campaign that can last for half a decade. So first question is, did I miss anything about what happens after the rate cut campaign begins?
Well, there's several things in here. So in addition to everything else I was working on this morning, I actually wrote a document called Public Debt as compared to corporate debt. And it touches on a lot of these issues in that it is the Federal Reserve that uses these levers, interest rates up, interest rates down, print money that'll cause inflations. They use the inflation to pay down their debt, US national debt, plus unfunded liabilities, to pay that down. So these are all levers, but these are all levers that are used against mom and pop. And mom and pop is the economic engine. So with regard to the idea that we're in a recession, we're not in a recession, the Federal Reserve doesn't even want to measure the idea of a recession because they've changed the term of the gross domestic product multiple times. Then you have gross domestic income, which nobody wants to talk about. So the recession would occur if there's 2 quarters of downward income, gross domestic income. And they don't want to talk about that. Well, clearly that has happened, because if it didn't happen, we wouldn't have the unfunded deficit of 1.8 trillion, give or take, at this very second. So the point of the matter is they're changing the definitions. They're moving the goalposts for purposes of creating a narrative. And the narrative in this particular case is extend and hope like hell we can figure a way out of this mess. But as I have said, nothing else matters other than the median household income, because that is who mom and pop are. And 37% of the household population are in harm's way of bankruptcy and are losing the roof over their head because the median household income doesn't exist to be paying off any debts on the federal side or on the state side by virtue of the school district fraudulent bond debt. It's all connected.
Now let's ask the question why, which is a really important question. Why would the Federal Reserve start a rate cut campaign? Now remember what the Federal Reserve is. It is a backstop for the banks. So the only reason that they're really going to start cutting interest rates is to stimulate, remember, to stimulate the financial markets. And why would they stimulate the financial markets? Well, because home values are now clearly going down. And even if the housing market goes down 1%, you guys, that is hundreds of billions of dollars. And that loss of equity, which by the way wasn't even real to begin with, absolutely devastates company. It leads to foreclosures because people can no longer sell or refinance, which they can't even do right now if they purchased after 2022. But when home prices go down, everything crumbles underneath it. Now, this article is very interesting and states residential real estate investments actively started to fall dramatically in 2022 and has stagnated in recent years. The U.S. saw $794 billion in private residential fixed investment in the first quarter of this year. That's down, you guys, 15.6% from its peak in the first quarter of 2021, according to the Bureau of Economic Data. What's interesting, that's just talking about investment in real estate being down 15.6%. When we went over the HUD figures, the most recent HUD figures, housing and urban development figures, for May and for June, they accounted for over $700 billion in negative equity in the housing market. That video is about to come out tomorrow. But again, you guys, that's not even counting July and it's not even counting August. So for May, for June, the housing market right now is down over $700 billion. And again, I'll ask the question whether or not Mitch thinks that they're going to cut interest rates in September. And I'm going to tell you guys right now, I think they will cut interest rates in September. But the premise here is to explain to you guys why they would cut interest rates. And so many people got this wrong from the beginning. Now, personally, I don't think that they should, but I think that they will, because what does the Federal Reserve do? It saves banks. And when banks lose hundreds of billions of dollars, who comes to the rescue? The Federal Reserve does. So, Mitch, my question to you is, should the Federal Reserve cut interest rates come September? Why or why not exactly?
It's really not that complex of an answer. The Federal Reserve more than likely will cut interest rates, but what they're going to do is do 0.25%, thinking, well, that's going to get President Trump off their back. The problem is, it isn't. President Trump and the Federal Reserve are at loggerheads. And we've laid the case out in multiple videos, as well as the documents that I've written, that the Federal Reserve in its entirety should be terminated. And if President Trump wanted to assist the population, repeal all the real estate taxes from a national level all the way down, insist that the governments and the governors do it, because that restores the economic engine and restores the properties back to mom and pop. That's job one. Once that's accomplished, terminate the Federal Reserve. Because as I have proven, the Federal Reserve is nothing more than a 50-50 coin flip. A 3-year-old with a quarter can do the exact same thing, literally, that Jerome Powell is doing. Is it up? Is it down? It doesn't matter. The 0.25% will have zero effect on mom and pop. So who does it really affect? And this is to answer your question specifically, Travis. The Federal Reserve is there for the banks. The 0.25%, who is it to the benefit of? Well, it's to the benefit of the federal government, because it lowers their cost of operation. That has nothing to do with mom and pop at the local level. And therein lies the problem. We have the solutions to all of this, but the bottom line is, what has to happen must be pushed from the government, because it is the government itself that will allow for the profitability of mom and pop. The job of the government at this point, clear the field so that mom and pop can run the ball. That is what President Trump needs to do.
And I want to warn you guys, to the viewers, if, and anyone you know, and this is a horrible thing, it's not good, but if you keep your head in the sand, you're going to get bamboozled. You have to know how these very simple things work, right? They're going to help the banks at whose cost, whose expense? At our expense. It's always at our cost. They're literally stripping our equity right out from underneath us. And if you can afford to live right now, I know for sure the reason you can afford to live is because you live a life that's frugal. And if you live a life that's frugal, then you know for sure that the cost of living is absolutely out of control, because you can't live frugal anymore. Let's talk about what to expect moving forward. I think that they're going to cut and start a rate cut campaign come September because they can't hide the data anymore. They've been hiding the data. The housing market's going down. These lenders are losing hundreds of billions of dollars. And again, they're going to come rescue their buddies. I hope I'm wrong, though. I really do. But according to CMA FedWatch, 91.4%, almost the entire market, expects a 25 basis point rate cut come September. Very interesting. What I really want to point out is how much a mortgage payment should go down if interest rates go down. The way I'm going to do that is by taking a purchase price of $400,000 with a 10% down payment, 30-year fixed rate mortgage at a 6.5% interest rate. You guys can see here at the top that that payment is $2,275. But what happens when we drop the interest rate by 0.5%? It goes to 6%. And let me calculate the new payment. You guys can see that the payment goes down to $2,158, which means that the payments go down $117 for a 0.5 percentage point decrease. But let's look at what a full percent decrease looks like. I go down to 5.5%. I calculate the payment. Here is our new payment right here, $2,044, which means a full percentage point decrease equals $231. So if your loan amount is around $360, $370, each percentage point decrease or increase for that matter is going to be $231. Something else we should expect is transactions to increase. If more people can afford a house, then more people will purchase a house. And right now, the housing market is an absolute dumpster fire. What I expect will happen is as interest rates and prices, the key word is prices go down, pending sales, I believe, is going to start going up, and more inventory is going to hit the market as the golden handcuff effect withers away. Mitch, I've told the viewers that I believe that there's going to be rate cuts in September. I told them why. Lots of asset price decline in the housing markets, turmoil, potential more foreclosures, loan modifications. The list goes on and on and on. But the question is, sir, do you, not if they should, but do you think they will start cutting interest rates come September?
Part of the problem with cutting interest rates is you cut them because the economy is starting to falter. So if the interest rates go down, the correlation will be so will the stock market. But that's a major issue. The other issue is if they cut them, because nobody knows the truth, but if they cut them, one must understand that the debt to income ratio that people should be buying should be closer to 21, not the 28 as currently or was acceptable. Now they accept 40. But the point of the matter is, given the inflation, 21 is what people, 22 is what they can afford. And the idea of a 25 basis point cut means nothing to mom and pop. It isn't going to move the needle because that is the Fed funds rate. That is not what you can borrow at. You still have to go to a private lender to get that money. Now, does that money end up at Freddie Mac or Fannie Mae, wherever it comes from? Nobody knows at this moment, but that's not the point. The point of the matter is they could cut 50 basis points and it isn't going to move the needle of what mom and pop can afford. And I worked it out. They can cut 200 basis points and it still isn't going to move the needle because that's the economic damage that inflation has done. So they can do whatever the hell they want. They're missing the point. If you want to fix the economic engine, repeal the real estate tax, all property tax, in favor of the uniform state sales tax, and give the balance sheet back to mom and pop where it belongs. That's how you fix it.
Now, Mitch, what do you think if we were to throw a percentage likelihood on your opinion, which I don't know how we would do that, but what percentage, do you think it's likely that they will cut in September? High percentages, what do you think?
Yeah, I think so, because President Trump has been putting an awful lot of pressure on them. And as far as I'm concerned, it's not enough. It literally should have been, we're going to terminate the entirety of the Federal Reserve. I mean, people don't understand this. It literally is a coin flip. It's a 50-50 coin flip. Hand a 3-year-old a quarter, heads, interest rates up, tails, interest rates down. That little child is doing the exact same thing that the Federal Reserve is doing. They can say, well, we have bonds to do this and this lever to do that, and we've got the reverse repo to do this, none of which helps mom and pop. None of it. It is there for the benefit of the banks. And they don't want to talk about it, but that's the truth.
That is the truth, and that is the facts. And, you know, in conclusion, here's what we really want you guys to understand. It could take a full decade for the whole cycle to play out, 5 years per pendulum swing. And that's why, you guys, it's so important to maintain your patience, make sacrifices right now, maintain your purchasing power, because there are going to be deals of your dreams right around the corner. And when I say right around the corner, remember how long this takes. Okay, so we've defined it. We've showed you through the global financial crisis. Stay patient, stay proactive, and in the meantime, do me a favor and help us to repeal property taxes by first going to Mockingbird Properties /DCAD. And if you're an attorney or even an elected official, because we've been talking to many, this is where you want to come. Mitch has so much on, I want to say abolishing, but repealing property taxes, because we also have a solution. So let's repeal it. Obviously, we want to abolish it, but we have a plan, you guys. He also has a bill. I mean, look at this. This is still going. I mean, look at how much work Mitch has done. Everything is right here. That's why we say the things that we're saying, because we have proof to back it up. And when you're done with that, you guys, don't forget, I have a criminal complaint and lawsuit going myself. So Mitch isn't the only one. I also have one for the assault and battery. So if you want to know what's happened to me and you want all the evidence, it's right here. Art, my attorney, it's also right here. He already has all this, by the way. And then I put updates here on the bottom. I actually have 2 more updates. We're on ABC News 13. They picked up the story, and I want to make also a special post right here that essentially says, I have finally found an attorney that has the spirit to fight and the patriotism to stand up for his community. Art, I love you, brother. I'm going to link your stuff in the description just in case you guys want to talk to him and you've had any other problems yourself with assault and battery from any government official. We can help you with that. Email me. His stuff is in the description. Mitch Vexler, I appreciate you. You guys, happy Thursday. Don't forget, save your money, rebudget, cancel your subscriptions, and don't go out to eat. And other than that, if you guys are out there investing in your lives, in real estate, the stock market, your retirement, your purchasing power, you guys already know we wish you luck and we hope you win.